All right. Welcome, welcome. Good afternoon, everybody. Today's Wednesday, April 30th. This is our quarterly economic update. We have a new guest today, Jay Coulter. Jay is going to be our host in a sense and facilitate our call today. So let me share my screen and we will jump in here. And so again, this is our second quarter update. And of course, we have an agenda. So, Jay, let me change my screen and you can lead us through the call.
All right. Thank you, Chris, and welcome everybody. This is the Global Market and Economic Update. It's important to remember why we host this event. Vision Based Planning hosts this event for you. We believe that educated investors are successful investors, and our focus is to guide our clients so that you feel confident about your long-term financial plan, and we highlight factual information, both the good and the bad, about the global economy. Here's what we're going to cover today. So, we're going to talk about the United States, both the good and the bad. We're going to talk about the international markets, which have become more important today than they have in the past, both the good and the bad. Chris is really going to dig into the fixed income markets, where it's very important to pay attention today. And then we'll wrap up with a conversation about our investment models, and then we will take questions. If you have questions while we're going through the presentation, please put them in the chat and I will post them to the team at the end of their formal remarks. So with that, let's start with the good in the United States. Brian, you want to kick us off?
Yep. Thank you, Jay. So this is a representation of showing the gross domestic product of the U.S. So year over year, our GDP in the U.S. grew by 2.5%, still trending above the growth trend line of 2.1%. On the right chart, just a reminder that over 2/3 of our GDP is driven by consumers. Just so keep that in mind as we go through here. Moving on, this is the representation of the quarter by quarter results. So last quarter, which is actually the fourth quarter of 24, was 2.4%. One thing of note, just look at the chart above, given that tariffs and imports, exports is a big topic today. Last quarter, the imports were a positive 0.3%. One thing you may hear, actually the first quarter of 2025 was just released this morning. So we'll still see what the results will look like on the long term. But this morning, the first quarter of 2025, the actual GDP, the U.S. economy contracted for the first time since 2022. And you'll see that there in that first quarter 2022. So the results this morning was a contraction of negative 0.3%. At least the initial data shows a lot of that was due to the imports, or the negative net exports being higher. So thought to be maybe some of this pre-ordering, pre-shipping of some of the tariffs. So we'll continue to monitor that as that goes forward, and that will those figures be represented in our next quarter's slides. But just in case you hear that, because that was released this morning. From a labor perspective, the labor demand remains good in the U.S. We still have more job openings than we have people looking for work. So it's gotten closer to a one-for-one ratio now, but by no means are we still have plenty of jobs available based on the number of folks that are unemployed. Kind of along those same themes, if you look at the upper chart on here, the labor growth remains positive. consisting of both U.S. and foreign-born immigrants. So you'll see there, we just had the negative period, the negative year during COVID, but since that time, we have continued to have a growth in the labor force. And then if you look down in the lower chart, and particularly more on the line in the light blue, which is represented by the axis on the right, the participation rate of persons ages 18 through 64 continues to be increasing since the period of COVID. So all good signs from a labor force participation perspective. Inflation. Since we met last time, inflation has come down 0.5%. So currently at the end of the first quarter of 2025, the inflation rate was at 2.4. If you recall from last time, it was around 2.9. It went up another tick to 3, just above 3, and then over the last 2 months, it's come down. So inflation continues to be trending in the right direction, or is trending in the right direction this quarter. You notice there on energy continues to decline. That was the lower decrease as far as energy, and then for example, the black and red auto insurance, that piece, that little sliver of the bar chart continue to get smaller, showing that our auto insurance, at least the rates on a national basis, have started to contract a bit. One other note, just kind of as far as wage growth is concerned, the wage growth continues to exceed inflation. It has for almost the last 2 years. So the current wage growth as of the end of March was about 3.9%. So, so we continue to see wages rising, going higher than the inflation rate, which is a good sign for consumers.
Excellent. All right, Brian, thank you. So this is my cue to cover what's bad about the U.S. This first chart talks about non-farm payroll gains. So this number comes out every month. As of March, this was a good number when it was released to say that we had 228,000 jobs in March. However, because it's such a short average of only 3 months, you see this gray trend line coming down. So that's not great. And that's because the January and February jobs reports were not that great. So this is something we keep an eye on. We'll see what the jobs report says for April and beyond. So the 3-month average at 152,000, it's just something that we monitor. So Brian covered what's good about the jobs itself is that there are over 7 million jobs and more jobs available than people looking for work, but new jobs coming out, that's something we keep an eye on. And there's a little bit of softness here so far in the beginning of the year. The next area that's not so great, that's bad otherwise, is our federal debt. So our debt is about the size of our what's called GDP, is our gross domestic production, which is everything that we produce. So where we are right now is just about at 100%. We're going to be expecting some tax legislation coming in the next 3 months, maybe as early as June. If some of these tax cuts come through and the economy does not grow by more than we cut, we could see an increase in our debt to our production. The suggestion would be that by cutting taxes, we can grow the economy. And so we'll see. These are some projections. We don't like to spend a lot of time looking at projections because we want to show you the real data. But this is a possibility that the taxes are cut by more than the growth. We'll see. Where we are right now is about 100%, and that's a little bit of a concern. And then the next piece is tariffs. So what you're seeing here is tariffs on US imports all the way back to the early 2000s, so 125 years. This is, as of April 25th, the maximum tariff rate estimate from all of the discussions that we're seeing. We've been as high as these in the 1930s and earlier. But the reality is that tariffs are a negotiating tactic. We'll talk about this as we go through the call, but the purpose of the tariffs, I was on a call on Monday, they act like a strike. So for example, and I'll show you this next slide here, the United Auto Workers went on strike last year against Ford and GM, and it was painful to Ford and GM at the time. They made an agreement, the strike was done, and everyone's better off in the end. In our opinion, the purpose of these tariffs is in a strike, in a sense, to bring down the rates from other countries. So these are simple average tariff rates with our top trading partners. So you just look at the biggest ones. India is 17%, South Korea 13.4%, Brazil 11.2%, Vietnam 9.4%. We'll just take those there. China is squarely in the crosshairs. We'll talk about that a little when we get down to international. But if we see these tariff rates come down to zero, the plan or the expectation is for that to lower inflation so we can lower interest rates. So tariffs right now are bad. We see them as a negotiating tactic, a strike in the sense to get these rates to come down. All right, so that's my part covering the bad.
Excellent. Let me summarize what the team said. First, with the good. GDP in the fourth quarter increased by 2.5%. And as Brian mentioned, we want to pay attention because it looks like we may have shrunk in the first quarter to a 0.3% level. Labor demand remains at historically good levels, which is a positive thing, along with labor force participation rising. And then we see inflation has started to edge down, sitting at 2.4% annually today, a very important factor to continue to watch as we look at the U.S. economy. On the negative side, the 3-month moving average for job openings has started to decline, potentially representing some stress in the economy. Debt to GDP is still above 100%. It has been that way for over 4 years now, and we want to continue to monitor that because with legislation potentially coming out later this year, that might continue to impact that number. And lastly, as we're all going to be watching tariffs, they're associated with uncertainty here as it relates to growth and the inflation numbers, but we will continue to watch. Now, let's move forward to the international markets.
All right, thanks, Jay. So first off, we're looking at rates, not only in the U.S., but also primarily in the international. So what we've got here is a rate chart going back about almost 20 years, back to 2006. So you can see, the early, I guess, 2006, 2009 timeframe. We've been in this type of rate environment before. We got accustomed after the financial crisis of those low rate regimes. So just to highlight a couple areas on the Eurozone, which is highlighted in the black line, the European Central Bank or ECB over the last quarter has reduced their key interest rate by 0.5% total since over the last 3 months. And likewise, what you'll see in the blue, the UK, the Bank of England has reduced their rate by 0.25% over, I guess I think it was February timeframe since we last met. So those two areas have reduced rates. What you'll see on the far right is kind of a dot plot, a projection, like Chris mentioned. We don't want to kind of get in conjecture projections, but that just gives you an idea of like the downward trend of most markets. The one exception to that on the international developed side is Japan. They're out of sync mostly as far as the interest rate and inflation rate regime. in Japan. So they are currently raising rates, and you'll see a projection of them potentially raising rates further, which we'll see a little bit more on the next slide. So this is the inflation factors for all developed nations and a few the emerging markets nations. So to highlight Japan, you'll see Japan up there at 3.7%. So given they, just like we went through here within the last several years, Japan is starting to see the impact of inflation, which subsequently their central bank is, the Bank of Japan is increasing their interest, their central key interest rate to help tamper down the impact of inflation moving forward. With the rest of the developed markets, you'll see there, United States and downward, all the inflation rates remain relatively low and contained. So nothing is getting out of hand from a international perspective with respect to inflation. As far as unemployment is concerned, just like the US, the Eurozone, and Japan, which are represented here in the two colors of blue, the medium blue and the light blue, those unemployment rates for both of those areas continue to trend downwards. And in the case of the Eurozone, it's in particular, you see it's at the lowest rate of this period here that we're looking at since I guess 18 years for 2007. So this is a chart we've seen before. They've added a little bit more color to this. This is looking at the global performance of companies, total returns over the past year. On the far right there, you'll see year to date, the first quarter of 2025. The purples, the light purple representing the international developed markets, and then the darker purple or emerging markets, you'll see the vast majority of the top performing companies from a total return perspective are outside of the US. The US had a very small amount of companies doing well as from a performance returns perspective in the first quarter. And we'll look at that a little bit further in the presentation. And just one other note with respect to international, Europe is currently in spending mode. I know, like in defense and some other areas. So that's one good sign about the international, as well as there's lots of spending going on. So they're coming out of the austerity measures on the positive side.
All right. So this is my cue to cover what are the concerns internationally. So tariffs, you're going to hear about this from us as well, but more specifically China. So China's pretty right in the middle of the crosshairs for these tariffs. And the reason we're having it in the bad category for this quarter is because neither country is talking about any progress. You hear about progress with all these other international companies that want to come to the US, they want to renegotiate. However, China, both countries are denying, or we're saying that we're talking to China, they're denying the fact that we're having any discussion. So there's more concern in this area. It's ongoing. Certainly not a positive at this point. And then the other piece is just bad actors in general. So you've got China, Russia, Iran, North Korea working together in this group. This is a slide from Fidelity, the defenders of Western democracy, so the US, Europe, and the like, and then these sort of non-aligned countries. So we'll see what happens. I do think that some of the global concerns are coming down. Terrorism, I think we will see less of that. These people are not as emboldened with this current administration. But certainly it's an issue. It's certainly a concern. All right, Jay, let me.
Yes, why don't I wrap up what the team just shared with you as it relates to the international markets. So on the positive side, interest rates have been lowered further by the European Central Bank and the Bank of England. Inflation remains relatively low, and Eurozone and Japan unemployment rates are trending lower. And international companies this year have been performing very well based upon their historical average over really the past 15 years. But on the difficult side in the international market, tariff threats remain real, and we need to pay attention to them when we look at our international allocations. And there's always going to be an issue around geopolitical influences. Bad actors could always go and impact the results we see from our investments in the international markets. With that, Chris, I believe I'm going to turn it back over to you for some commentary on the fixed income markets.
Yeah, so fixed income, another name for this is our more conservative part of the portfolio. If you break down the word fixed income, it means our income is fixed. That is derived from interest rates. So where I'd like to start on this chart is on both of the outside parts. So this is what yield to worst means is, think of it like your interest rate. The worst interest rate you could get, for example, if a bond is called away. I won't get into the weeds about that, but it's the minimum interest rate we're guaranteed to receive. US Treasuries here, you're seeing the current interest rate at 4.1%. If I were to draw your attention to the far right side, leveraged loans, these are short-term loans, interest paying 9.3. US high yield, 7.8. So what's good about interest rates now, given the fact that interest rates have been higher than normal, is us collecting these coupons. The next piece is we're also anticipating interest rates to come down. Brian covered inflation coming down. The expectations with the tariff strike is to lower tariffs globally and lower inflation. If that were the case and inflation comes down and you see interest rates go down, you see capital appreciation in the bonds. This is separate from the yield. And you see that in this dark blue bar chart, and you see the positive results here. So again, imagine a seesaw in your mind. We have interest rates here, or yield, and we have bond values here. And as interest rates go down, bond values rise. So we're expecting this to happen over the next 12 to 24 months. And this is a good thing. Okay, what's bad about high interest rates? Well, it goes back to what I had mentioned previously, which is our federal debt and deficit. So this is a chart from JP Morgan. It shows our 2025 federal budget. The budget for this year is $7 trillion. You see that right on the top here. If I draw your eye to the right, the deficit that we spend is 27%. So we are gonna add to the deficit by just under $1.9 trillion. You see the tariffs here. This is as of the end of the last quarter, 80 billion. It may be more, 160 billion, which is 1 to 2% of the budget. Now you can make an argument to say, well, it's only 1 or 2%. 80 billion's a lot, 160 billion's a lot of money. It's meaningful from a total cost perspective. Well, so again, what's bad about higher interest rates is the interest or the mortgage. We have to pay the interest on this, which is $952 billion in interest in our US Treasury payments. And that represents 14% of the budget. So 14% of the budget is to pay for the mortgage. In June of 2022, the interest we were paying was $400 billion because interest rates were lower. That was 7% of the budget. So again, as interest rates come down, we'll refinance our debt, and we can then see and expect the net interest from a total dollars perspective and a percentage basis to come down. All right, that's the bad about interest rates.
Well, Chris, why don't I kind of summarize what you shared with everybody? So On the good side, as it relates to fixed income, bonds are providing great income today. We are clipping the coupon. Investors will remember 10 and 15 years ago when you invested in fixed income, those yields were very low and not as advantageous from an income perspective. The team feels that interest rates will decline if inflation falls further and the projected tariff impacts start to decrease. The coordination of those two will help in the total return of your fixed income allocations. But on the negative side, the higher deficit spending could result in larger deficits, which is going to be more interest we as a country have to pay. So as we move on to the next section, I believe, Brian, are you
Yep.
going to talk about how
Yes,
we
sir.
apply this?
Yep. So thank you. So this is the area that where we kind of sum up things and what this means for you and your accounts, that we manage for you in the investment. So this chart here is shows the Magnificent Seven stocks that are in the S&P 500, and the Mag 7 stocks are Apple, Microsoft, Alphabet, which is otherwise known as more often known as Google, Amazon, Nvidia, Meta, and Tesla. So all those Mag 7 are typically known as like US large cap growth stocks. So one of the things that we did, and we actually started this in January of this year, so first quarter of last year, is we started to strategically shift um, between growth and value. And in that, and what you'll see there is the Mag 7. You'll see the Mag 7. While some of this year, the total return has not been so good relative to the S&P 500 index in general. In previous years, it's had some really good years, and some really not so good years. So very volatile as far as performance year over year. So one of the things that we were cognizant of, and this is once again, we started in January, is we wanted to make sure we minimize the overlap of companies being held in our U.S. large cap and uh, U.S. large cap value and growth allocations. So we made that focused effort just to make sure that we didn't have a repeat of a lot of the Mag 7 companies in both of our investments that we have in our allocations that we manage for y'all.
Mhm.
On the international side, this is a chart looking at the non-US, the international equity valuations. So the relative value of the international remains very attractive. What this shows here is the PE ratio, which is the price earnings ratio. So if you look over towards the right-hand side, in the blue line, that's the international developed markets. And you see the dotted line, you'll see a solid line there, um, which is the current valuation, and then the dotted line represents the historical valuation. So that basically represents what that shows is that the relative valuation of international is still below the historical trend. Um, and one of the things that we're going to be looking at further in the months ahead is potentially shifting some of our equity allocations, the stock allocation from US to international. Not a major change, but just starting to migrate a little bit more over towards international. And given that the valuation's attractive, and then what we're seeing basically in the global dynamics is international is getting in a better position to perform better in the time ahead. And some of that, which we've already seen so far this year. So on that point here, so this is a representation of last Friday of the returns of various indexes. So what you hear a lot about is for the US is the S&P 500, the Dow Jones, maybe a little bit of the Russell, the NASDAQ. All of those headlines, which you often hear about so far this year, are all in the red on the negative year-to-date total returns. However, As you see in the MSCI EA, that's basically MSCI EAFE is the international developed markets, and then EM is the emerging markets. Both of those indexes are positive for the year, 10% and almost 3% respectively. So that's one of the main reasons why we remain diversified, is because even though you've got a lot of the negative headlines about what's happening in the US market, your portfolios are not feeling that impact because we've also got allocations towards international, which have been positive for the year.
So when you think about that and how we're going to go and use the information we talked about for the US markets, international markets, and fixed income, how are we going to apply this on your behalf? On the fixed income side, we are actively managing duration as it relates to interest rates. Chris really went deep on why we are doing that. Remember, if interest rates come down, the value of your bond portfolio should go up in value. And then on the equity side, we are minimizing the overlap between large US growth companies like your NVIDIAs and your Googles, also known as Alphabet, and your large value companies like your Coca-Colas and your Home Depots. That's going to provide better diversification in your portfolios. Also, going forward, the team is thinking about potential migrating over towards a little bit larger allocation to the international markets since they seem to have recovered. And so with that, how about some food for thought?
Yep, I'll take us through this. So this last section, we review charts, and you're seeing charts from 4 different companies. So you see up here, this is First Trust. We take charts from Fidelity, JP Morgan, Schwab. So that's why you see the layout in different ways. This is highlighting average volatility. Volatility is defined as a 1% move up or a 1% move down, either way. Average on an annual basis being 65 days out of all the trading days. And as of the end of the first quarter, we're at 21. So we multiply that by 4, that would put us at 84, which puts us at above average volatility. So those feelings that we're feeling is natural. Additionally, it's well greater than 1%. So we are in a very historically volatile time, which is why you get the messages from us that we do, making sure that just confirming the feeling is real, of course, that yes, it's volatile, but we're staying focused on your long-term financial plan. Next, this is a chart from JP Morgan. And what this is showing is the intra-year decline that you see in red versus the calendar year in this gray bar chart. Now, what you see is that every year, there's some point, there's some negative returns. Most years you end positive. So it says here annual returns are positive in 34 out of 45 years. That's about 75%. Year to date, we've seen a decline of 19% at the maximum. And where we are now is -6. This is as of April 25th. So we've seen a 13% increase. This is the S&P 500 since the greatest decline, and all of that happened this month. So we're about a third of the way through the year. We'll see where we end at the end of the year, but just wanting to plant the seed to not necessarily evaluate yourself, on a daily basis. And coming back to this chart from First Trust, which shows the S&P 500 and the type of decline. So we see a -5% or more downdraft 3 times every single year. We see -10% about every year and a half, -15% every 3 years, -20% every 5.5 years. So in March of 2025, well, we crossed this threshold, and the prior time was in August of 2024. We hadn't even seen that in in that amount of time. 10% previously was October 2023, so we were somewhat expecting it. Sure enough, it happened. And again, just like JP Morgan showed us, in April, we crossed the negative 15% mark. So by the time this is updated next quarter, it'll say April 2025. So we may be done with the volatility and the downdrafts, or maybe not. None of us can predict the future. So we may see a 20% more. If we're looking at 5.5 years, that would put us at 2027. But who knows? So it's possible we could be done with the downdraft and see some gains and end the year positive. But we're showing you this to provide you the confirmation of where we are now and maintain the focus on your financial plan and not allow these other distractions to influence your long-term plan. All right, so this is what we have prepared for the presentation. As Jay mentioned, please put your questions in the Q&A. We can certainly go over and review any questions you may have. If you have questions, likely other people have the same one. So go ahead and throw your questions out there, and we're happy to review anything you might want to know more about.
Chris, I have one for you and Brian to start with here as it relates to investing in international markets and in particularly China. What are your thoughts on allocating to equities in China at this stage of the tariff game?
Well, I'll say that when you look at China, there's the concern is that they sort of manipulate the game to benefit them. The reality is having some exposure to China is a good thing long term. I can show you a chart from Fidelity also that shows you the cyclicality of their country, and they are moving in an expansion areas. While I grab that slide, Brian, let me let you comment on having an allocation to China as a subset of the overall international.
Yeah, so we do have a subset. I mean, one of the core emerging markets holding is a emerging markets dividend fund, which does have some weighting to China, but it is not a predominant weighting. It's not overweighted towards China by any means. So it's well diversified amongst the various emerging markets, whether it's, would include Central and South America, India, Taiwan, Korea. So our fund itself is not necessarily weighted, and we would not want to weight necessarily towards one country or another, and particularly not China, as far as going all in within emerging markets.
So this is a Fidelity chart that shows us where different countries are in the business cycle. And so you see here's the Eurozone, Canada, and China. They're in the early part of their expansion of their economic cycle. And here we are, more of the international developed in the late stages, not in a recession by any means. But we've had some good growth for a period of time. There will be a recession eventually. We don't know when. There are a variety of metrics that define what the definition of a recession is. And just because we had some negative, so I'm going to come here and show you and reiterate one of the things that Brian said. So as you're watching in the news, you will hear negative 0.3% GDP, negative news. That's because of all of these countries importing goods to get ahead of tariffs. And so Brian pointed this out, net exports, i.e., this slide keeps doing this, is acting up on me. Let me go down and up. All right. I'm going to stop clicking on this slide. When you have more imports front running the tariffs, that's a bigger negative number. But when you factor in these other components, consumption, government spending, and investments, when you strip out the imports, it actually grew by 3% in the first quarter. So some tariff gimmicking, gaming, this number will be negative 0.3. It is what it is, but it has to understand the context of the why of the negative 0.3% of the front running of the tariffs. That's all that is. And this is exactly why we're hosting this call. So you don't turn on the news tonight and get some big thing about, how the economy shrunk this quarter, because when you strip out the exports, it actually grew by an annualized 3%.
So,
All right.
Chris, a follow-up question then that could
Yeah.
actually have some implications or have some tie-ins to that answer. Net imports, one of the thoughts is that the United States has been importing a lot of gold. The price of gold has gone up a lot here over the past 12 months. Any thoughts on gold in your client portfolios, and how should investors think about all these silly gold ads we're starting to see on television and online?
Well, that's just it. I mean, you hit the nail on the head, which is you start seeing advertising on TV, that's like, stay away. It's gold is a commodity. It's just like anything else. And with a commodity, it is not necessarily correlated towards any particular other what's called asset class. And we try to be speak in normal terms. So for example, portfolios are designed to have something called negative correlation. What is negative correlation? Negative correlation means that when one thing does one thing, the other thing does another. So for example, stocks and bonds are typically negative correlated. So if stocks go down, bonds go up. They're like a buoy. Typically, international and the US historically negatively correlated. One goes up, the other acts in reverse. That's the definition of having a diversified portfolio. Gold is not correlated to anything. It is strictly a fear-based asset. And when you see investments growing 7 times out of 10 and 3 times out of 10 investments having, a dip, I'm going to go with the 7 out of 10 and not the 3 out of 10. So our suggestion is to resist the temptation to want to buy gold necessarily, because it's a fear-based asset. And once that fear dissipates, you'll see the price of gold, basically all the gains that they give it all back. Warren Buffett, and Brian, I'll turn this over to you. Warren Buffett famously has compared the S&P 500 to the price of gold, and you look at the long-term chart and you have a huge gap between the S&P 500 and the price of gold down here. Brian, what are your thoughts about this?
Yeah, I mean, really much the same. It's commodities in general over the longer term, they have minimal, if any, positive return. And so with gold being included in them, so people tend to go to gold as kind of a safe haven. So like you mentioned, once that those concerns are gone, the price of some of the concerns that may be brought about by tariffs and what's going on now, once those subside, there's a good probability that a lot of those folks that are in gold are going to be exiting the door and the price decrease. So
yeah. Got one more question for the team. Before I pose it to you guys, for those watching live, if you have any questions, throw them into the chat now. We have time to bring the question to the team. All right, guys, this is a loaded one. Here recently, there's been a lot of press around AI and its impact on the jobs over the next 5 to 10 years. Some estimates suggest that 80 to 90% of all jobs could be eliminated by AI and robotics. Now, those are obviously some clickbait headlines, but there is some real risk to robotics and artificial intelligence removing a lot of jobs out of the global economy. How, as investors and portfolio allocators, should you be thinking about this? And how should your clients as investors be thinking about this ever evolving dynamic?
Yeah. I mean, so AI is going to be transformative within our economy. And I think that that's not a stretch to say that. There are lots of benefits to it. Some of them are, I think, Jay, like you're alluding to, a little overblown. It's not a silver bullet, but there are going to be some efficiencies. So we've used some AI even within vision-based planning over the last year. Some of it's been good. Some of it's been like not that good. It's like, oh, I thought it was going to do this, but it really didn't. There is a knock-on effect of this AI, which is the power demand. So as you think about other parts of the portfolio, utilities, energy, there's going to be a benefit to that part of the portfolio because this demands a lot of energy. So part of the portfolio will benefit naturally from companies using AI more and needing that additional energy. The concern about the jobs is one of those things where we'll have to wait and see. There is a huge, we were nervous about our jobs being replaced by AI. Me personally. And what we realize is that as humans, it can't think the same way. And for each of us, as we think about our plan and the clients that we work for, the computer cannot humanize it. It's not a human. So it doesn't always understand what the person's going through. And so, in my opinion, there are benefits to it. It's exciting. I'm excited to, enhance all the services that we're providing clients leveraging AI. But I think some of the concerns may be overblown in terms of job loss, because I think they'll realize the human component to any type of service is unique, and it will be very, very hard to replace those aspects. Brian, what are your thoughts here?
Yeah, I mean, to me, it's the same. I mean, you're looking like for example, robotics. I mean, that may not jump, that may facilitate manufacturing. So, there's ways actually could create jobs. On the other side is like, yeah, it may be seen as replacing human workers in some cases, but then again, it also may facilitate manufacturing and bringing manufacturing over into the U.S. or building more manufacturing plants or diversifying supply chains. So there's a couple of different sides, I guess, to it. You can see it as might be replacing existing workers, but then again, it may actually make it easier to enhance what we've got or build upon or grow what we've got today as well. So, but it's a lot of companies, industries, both from the services side and the product side, are still trying to figure out what works, what doesn't work. So the adoption of AI is yet to be seen, the full benefits of what it will do. And to Chris's point, we are very much limited, on an energy perspective, energy production, energy grid. There's lots of things associated with AI that may end up being, I won't say roadblocks, but maybe some hurdles as far as the proliferation of the technologies.
So, Chris, that wraps up the Q&A session.
Yes, please give us feedback. I think by design, we have like 3 or 4 super simple questions to answer. Please give us feedback. We review the feedback on a regular basis. So let us know what you like, how can we improve, and we look forward to seeing y'all next quarter. Thank you. Bye-bye.